Hi folks, welcome to this video. Please do read the disclaimer. Today we're going to talk about formats of gold. In what all formats can you buy gold and what you should avoid? So while predominantly this video is going to be about electronic format of gold, but I'll also give you my viewpoint on physical gold and other uh, formats. So if you were to consider the prime property of gold, the prime characteristic of gold is that there is no counterparty risk. This is the only asset which has no counterparty risk. He who holds the gold owns it. Every other asset has a counterparty risk, and I'll explain this. Now, let's say you have stocks sitting in your demat account. They're actually owed to you. You have the ownership on paper, but there is a counterparty where those stocks are sitting. If that counterparty fails, there is a chance that some disruption is possible. Let's say your money is sitting in the bank, you have a FD in the bank or whatever it may be. The bank fails. That is the counterparty risk. The bank owes you the money, but there is a counterparty where if it goes down and the government doesn't back it in case, then you've lost it. You own real estate, you are sitting on that real estate, but your ownership is proven by the municipality record. So that record is basically a counterparty which tells you that you own it. If that record is manipulated, for instance, or destroyed, there is an issue. So all formats of asset classes are having this kind of an issue where a counterparty risk exists. Your value of your asset is dependent upon the counterparty being in good shape. Now, India's Reserve Bank gold was also sitting hugely in international uh, vaults with Bank of England, with International Monetary Fund. They have got about 200 tons of it back. Why? Because there is a counterparty risk. Russia's gold was confiscated in 2022, and now every government realizes that if you don't have your own gold, it may be confiscated. So that counterparty risk again comes to play. If you give your gold out on loan, you may have raised 60, 70, 80% of that money, and some haircut is there on your gold. There is now a counterparty risk of getting your gold back. So all this basically is about the basic nature and characteristic of gold, that if you have it in your hand, it's yours. That's the counterparty risk negation, so as to say. So all countries, all reserve banks, entire, if you watch a documentary on Fort Knox, the huge area which is cordoned off, and there is, I don't know how many layers of security on that. It is owned by the government of the United States. Now, as soon as you move from the physical world, because the financial market loves to financialize assets and create leverage on it or create multiple owners of it. This is the favorite pastime of financial experts, how to get more and more people to uh, sort of trade on an. So if there is 100 kgs of gold existing in the world, let 10,000 kgs trade on that 100 kg. So there will be a lot of contracts between thousands of people who are promising each other that I will give you, by the end of this contract, this much delivery, but nobody really has it that much. So it's a leveraged bubble as such. So smarter people have devised other mechanisms like ETFs. Uh, there is a animal called digital gold also. Now ETFs are regulated by SEBI. They are supposed to have one-on-one backing of gold. However, units that they issue on the they're traded in the exchange. However much are the outstanding units, the backing of it should be there in physical gold with a custodian. They are supposed to have a certificate of custody. Any investor should be able to go to their office and see that certificate of custody. And periodically, they have to report it to SEBI. So there is some protection, confidence that the gold exists. Although, if you will read the fine print of any mutual fund or any ETF, it will say we have the ability to invest in gold or gold equivalents. Now, this gold equivalent word means that they may not have gold, physical gold. They could have gold futures also, or they have some contract with a gold miner that so much gold is due to them. All those kind of gimmicks are possible. I'm not saying anybody is doing this, but this is possible because of these legal wordings that are there in ETF documents. And this is not just Indian documents. If you go check the GLD, the world's largest ETF, there also the document wordings are like this. So while nothing will happen in normal course, when something hits the fan, perhaps one of such institutions may decide that no, I will not hold 100% gold, and I'll try to leverage on this. So those kind of things are possible. Now, digital gold is something very very opaque. So let's actually get into this video. So imagine buying some quantity of gold from three different digital platforms. So digital gold is something where they've just made it very easy to buy gold digitally. So and the minimum ticket that is required is also basically nothing. So you want to buy 10 rupees of gold, you can buy 10 rupees of gold. You want to buy 50,000 rupees of gold, you can buy 50,000 rupees of gold. There is a platform. You have an app. You go there and say, okay, I want to buy 25,000. It will say, okay, your account is credited with 25,000 rupees worth of gold. And you can go on that platform again and sell it at some other point. It will tell you what is that they are offering for sale as a rate, and the difference is what your profit or loss will be. So three different digital gold platforms, and this report is from Mint, uh, sorry, FYN Print, on by Neil Boret. So three digital gold platforms, the same buy date, that of 10th of October, had a buy price of this, and this, and the three platforms had a sell date of this, and this. So if one had a transaction on any of them, your outcome of PNL was different on each one of them. Now, I'm not at all trying to insinuate that these platforms are doing any mischief, but this is the fact that has been brought out in this report. So, in percentage terms, the first platform showed a loss of 2.2%. The second platform showed a loss of 3.6%, and third platform should have been more, but the PNL was 450 rupees versus this. So this figure seems circumspect. And on the same days, on 10th and 13th October, the IBJA rate. Now, what is the IBJA rate? IBJA rate is the Bullion Jewelers Association, the Indian Bullion Jewelers Association. It's a group of uh, market makers, you can say, who determine what is the price of gold twice a day. And the Reserve Bank, for uh, its purpose of maturing sovereign gold bonds, etc., depends upon the rate announced by IBJA. So there is a website called ibjarates.com. Please go and see that. It will be good knowledge for, and they announce a price at 12 a.m. and 5 p.m. every day. That's the sort of the market determined price of gold for a 995 purity and 999 purity. According to that, instead of losses on this 10th October buying and 13th October selling, it should have been a profit as per those prices. It was 12,152.3. So there is right now a complete mismatch of what these prices should be at any point of the time. So digital gold, which is just supposed to track gold, it is a easier, simpler format of buying and selling gold. Why should it have radically different prices and returns? depending upon where you buy it. So the problem that this digital gold has is that it is an unregulated space, and there is no benchmark basis which any regulator, any regulation is there, that why are you offering this price and not that price. Nobody can question the digital gold proponents. It is their choice what will be the price of gold to be shown on their uh, portals. So maybe in their own rights, they are right, whatever they are offering. They have no obligation to match it to their next competitor. But everybody has a different price basically. It's like it's like almost like that the commodity is not the same. One is selling gold and the other is selling some gold plus X and third is selling gold plus Y. Why are they not same? Because of the reason that I mentioned. Now, even if there is a same day, if you were to see the buy and sell according to the same report, again you are finding significant differences between different platforms, and basically it is the buy and sell spread. So every market, as you very well know, has a buying quote and a selling ask. So the gap between the buy and sell price can sometimes be huge. So, for instance, in this third platform, the selling price is 12,136, but the buying price, if you want to go buy on that platform, you'll pay 12,785. So, the 5% spread between buyer and seller, of which 3% you can say is because of GST, because when you are buying, you also have to pay GST on that. Now, the structural issue that I already mentioned to you is that there is no regulation, and these platforms do not come under SEBI. Uh, it should be actually. There is no reason why gold ETFs should be under SEBI and not gold, uh, digital gold. But there is a sort of a technical nuance there, that ETFs, because they are listed on the stock exchange, have to be under a regulator like SEBI. But digital gold, which is also an investment option that people have, should have some investor protection of some sort. Uh, so SEBI has specifically stated that it does not regulate entities in digital gold, and the other sort of problem with digital gold is that you are stuck with the platform that you buy gold from. So let's say you buy gold from platform A, you can't sell it to B now. You have to sell it to A only. Whatever rate, good rate, bad rate, whatever they offer you, because you never got gold in your hand. You only had a IOU saying that you have 10 grams of gold on your name. And whenever you will uh, go and sell it, you'll have to sell it to the same person, same platform, and whatever rate that they offer, you will have to get that. Now, as I mentioned, GST is applicable on every purchase of digital gold. So 3% is what you pay upfront whenever you buy gold, and when you go and sell it, obviously that tax is not coming back to you. So 3% gap between buy and sell is still understandable, but beyond that, to have couple of percentage more is certainly very difficult to absorb. Now, the other sort of discussion on this is that, so why are people buying um, digital gold? Number one is the convenience. It is right there in one of your apps. Your money is sitting in that wallet, so you can just say, just move this money and let's buy some gold. So that people, those platforms are basically using your presence and your money, which is sitting with them, to make you purchase or sell uh, uh, gold on their own platform. And it's a great business actually. From their point of view, if you can make 1 or 2% on gold in just buy and sell spread, there is no better business than that. Now, the other part is that a lot of people don't have demat accounts, they don't have a broking account. So, going to the ETF itself is a hurdle until you cross that hurdle. And the third one is that if you are going for gold mutual funds, for instance, There also you will need some, create some account, go to the mutual fund website, send money. They will then, credit you with the units and so on and so forth. Now, mind you, each and every of the other options that I mentioned, whether it is ETF, whether it is mutual fund, gold mutual fund, also has a cost. So this, um, let me clarify on this 3% GST business. A lot of people don't buy physical gold because they feel this 3% GST paid on physical gold is too much. And some making charges if you're buying a bar or some coin or something like that. Now, what happens? Let's say you are holding a ETF for 10 years. Mostly, see, gold, whenever you will be investing, you have to invest for long term. If you get a short term gain, that's your luck. It's an asset with long cycles, much longer than the stock market. So if the average stock market cycle is, let's say, 7 8 years, the average gold cycle is like maybe perhaps 8 to 12 years. Um, so it is a longer cycle, and you need to hold it for that cycle. So assuming, let's say, you hold your ETF for 10 years, every year the ETF is charging you a cost, right? So for some ETFs that may be 0.5%, for some it may be 0.8%, some may be even charging you 1%. So the cost of the ETF over a period of 10 years becomes huge. It's almost, it's compounding, but on a simplicity calculation, you're paying more than 10% over 10 years. So this 3% or 1 or 2% of some making charges, etc., is actually not so bad if you're going to hold for a long term. And as I said in the very beginning, the whole idea of gold is that it should protect you when things are really, really bad. And when things are really, really bad, a lot of these structures, platforms, AMCs, they become vulnerable. Don't go too far back. In 2008, people were not sure if ICICI, HDFC kind of banks will survive. There was a scare. There was a run on the bank, and it has happened many times in different parts of the world as well as India. So whenever extreme crisis will happen, financial products will take a dive because the confidence, the trust breaks at that time. When everything is going well, like right now, nobody has a trust issue. But as soon as you have one ETF in the world fail, a trust issue will start to rise. I don't know what my ETF is doing. So till everything is fine, there's no question. But as soon as something starts to break, people run towards safety, people run towards trust. Why don't you think the central banks are buying ETFs? They can also buy ETFs. They buy a lot of stocks. The Swiss government buys the stock of Apple. It buys Nvidia. It can also buy GLD. It need not store physical gold. Because when you look at the Exter's pyramid, the entire thesis is that physical gold is that asset on which the entire financial world is built upon. So that's sort of the allure of the physical gold. So anyhow, coming back to the digital gold part. So gold ETFs, gold related mutual funds are certainly better because they are regulated products. They have some standardization of pricing, although we are seeing that whenever there is price dislocation, whenever there is volatility in the market, there is price dislocation in ETFs. So if the market really goes up, you won't be able to sell at that price because there are hardly any buyers there. If it really drops down, you will not be able to buy at the bottom because there are no sellers there. So ETFs have their own issues, but at least they are regulated, and investor protection and grievance redressal mechanisms are always in place. So that's the sort of larger picture. Um, the expense ratio is lower on gold ETFs. The digital gold has a big amount of spread between buy and sell. Trading and liquidity is very, very high on gold ETFs, at least some of them. On digital gold, it is dependent upon the provider's platform, how much spread and liquidity they provide. And of course, ETFs are highly regulated versus no regulation in digital gold. So convenience, yes, But lack of regulation, price spreads tell me that, at least I don't want to be in that space. And whenever you are investing in something which is pristine, sort of, hedge to your other assets, um, you need to make sure that in times of trouble you should be able to access it, and the ease of use should be there for you to do that. So what has been your experience with digital gold? Please let us know in the comments. Do watch this other video if you have, uh, if you've liked our videos. Do subscribe to our channel, and do like and share this video. Thank you so much. I'll see you in the next one. Bye.